Market conversation here is elevated volatility. It remains a sticking point for investors in this new regime. Here to discuss, we've got Candice, who is Goldman Sachs Asset Management Global Head of Strategic Advisory Solutions. Great to have you here with us this morning, Candice. First and foremost, as we're hearing conversations coming out of World Economic Forum and Davos around and acknowledging what a mild or a shallow recession might look like, but then also in the same breath saying, hey, we're out here to make deals and govern our business to really weather through that. How can investors glean insights from that in order to position their portfolio best?
Absolutely. Last year, 2022, a lot of investors faced alarming headlines across the board, whether it was high inflation prints, central banks raising rates, and then also you had all the geopolitical activity that was happening across the world. So all of this contributed to that extraordinary year of volatility. So as an investor, just to put into perspective what we've been through, essentially we had 219 trading days where the S&P 500 moved over 100 basis points intraday over the course of the last year. That means 85% of the trading days that we experienced last year were highly volatile between beginning to end of the market. And with that said, we think that moving forward over the course of the next decade, as we move into this next cycle, we think there's going to be more levels of volatility in our future. So the things to consider given this type of environment, we think that investors should really start thinking about left tail risk, but also really focusing in on asset classes that they traditionally haven't thought about within their portfolio construction, and also active management. Those would be three ways that we think investors should start thinking about their portfolios moving into a period of more elevated volatility to come.
Well, let me ask you, can you enumerate some of those alternative assets that you were talking about that are available to retail investors? Because a lot of those are only available to institutional investors.
Absolutely. There are a couple of different avenues for normal investors who have the ability to invest. For example, multi-strategy hedge funds is one way that they can access a diversified portfolio of hedge fund investments. Typically, if you're able to diversify your portfolio with multi-asset class hedge funds, you can actually increase your potential for return, especially as you compare it versus the S&P 500, especially in times of volatility. The other area within alternatives I would talk about is private assets. So if you're looking to maintain a long-term strategic allocation and portfolio construction, this is a way that can enable you to stay focused on investing in the long term because you do have capital locked up for anywhere from 10 to 15 years. So again, that really depends on the wherewithal for clients, depending on where they are in terms of their investment acumen and sophistication. But there are ways to access multi-strategy hedge funds, but also private credit, private equity, if they have the ability to.
What would you be looking for? Kind of a concerted turn in the markets here. And of course, we had seen the rally of the past couple days here, but then you think about going further out into 2023 and getting past this first quarter and the ripping off of the Band-Aid as we continue to talk about that many businesses are doing right now just to set expectations. When is that concerted, that turn from your calculus and your estimation?
Absolutely. We all know that the equity markets in particular is a forward-looking mechanism and machine, and it tends to move before economic data is in place. So with that said, with many firms calling for a recession, our firm being one that is on the lower side of the probability, we still believe that there is an opportunity for a potential soft landing, the potential to avoid a recession. But nonetheless, it's going to be a tough year. Given our base case of no recession, if that is the correct call, we do believe that markets probably stay around the level it is today, around the levels of 4,000. But as you know, forecasting is more of an art than a science. So in thinking about what that means to have a 4,000 level on the S&P 500, that would mean earnings of about 0%, so earnings growth, and the earnings level of 224, which is exactly what we ended last year, 2022 at. That's our base case.
All right, we got to leave it there, but really appreciate your insights here. As always, Candice, Goldman Sachs Asset Management Global Head of Strategic Advisory Solutions.